So you found your house, the offer was accepted, the loan is moving forward, everything looks absolutely fantastic. Then suddenly, your lender calls and says, there's a problem. Your credit score changed. Yes, this happens more often than people realize, and it can throw your entire closing timeline into chaos. So the question is this: why does your credit score change during escrow, and what should you absolutely do under no circumstances when you're under contract? Well, that's what we're going to be discussing today, my friends. Hey everyone, thanks for tuning into 2 Minute Tuesday. I just want to quickly ask that if this video helps you in any way, please subscribe to the channel. When you subscribe, you're signing up for long-term value with weekly videos that break down real estate terms, share tips with buyers and sellers, and help you think through the lifestyle side of real estate decisions. Now, the goal of this series is actually simple: to help you avoid costly mistakes before they happen. Now, as I mentioned a moment ago, today we're going to be talking about something that surprises a lot of buyers. Your credit score does not freeze when you go under contract. In fact, your lender will usually check your credit before then once during the loan process. They pull it during the beginning when you apply, and then they pull it right before closing to make sure nothing has changed. Now, some lenders even run a soft credit check in between if escrow period is stretching longer than expected. Now, most buyers, they assume that once they've been approved, they're done. But lenders verify financial stability all the way up until closing. And this is where problems can show, because even a small change in your credit profile can affect your loan approval. And we're not talking about major financial disasters here. Sometimes a shift of even 10 to 20 points can push you below the threshold that changes your interest rate or your loan program eligibility. And in some cases, it can cause a full-on denial. Let's talk about the most common mistakes. Number one, opening up new credit cards. Even if you're just trying to buy furniture or appliances for the new home, a new credit inquiry or balance can lower your score. That credit card that you open at the furniture store to get the 15% off, that could, cost you your house. Number two, financing a car or making a large purchase. Now, the new monthly payment changes your debt to income ratio, and that can impact your loan qualification. Now, I've seen buyers finance a car 2 weeks before closing and lose their approval. It happens. Number three, missing or being late to any payment, even something small like a store card or a subscription, can cause a score to drop. Set everything to auto pay if you can. Do not let a forgotten $30 bill derail your home purchase. Number four, closing existing credit accounts. Now, this one catches people off guard, and you might be closing an old card thinking that this is responsible, but it can actually reduce your available credit and raise your utilization ratio, which lowers your score. And number five, moving money around without talking to your lender first. Large transfer or unusual activity can trigger additional questions during the whole underwriting process. Now, if your cousin sends you $5,000 as a gift, your lender is going to want documentation. If you shift savings between different accounts that you have without a clear paper trail, that can delay your closing. And here's the big takeaway most buyers don't realize: you are being financially evaluated all the way up until the loan funds, not just at the beginning. Your lender is watching the full picture right up until the moment the money hits the title company's account. So what should you do during escrow? Keep things boring. Seriously, pay your bills on time. Avoid any new debt. Don't make any big purchases. Don't co-sign for everyone. And don't change your jobs if you can help it. And talk to your lender before making any financial changes. Now, if you're unsure whether something will affect your loan, pick up the phone and ask. That 5-minute conversation can save you months of headache. The safest strategy is to act like your finances are frozen until you have the keys in hand, because the last thing that you want is to lose your home over, something that could have been avoided. Now, here's the bright side. This is actually easy to manage once you know the rules. Most escrow credit issues come from buyers simply not realizing they're still being monitored. And now you know. So if you're under contract or planning to buy soon, remember this one rule: no big financial moves until after closing day. Buy the furniture after you close. Finance the car after you close. Open up new accounts after you close. You can see the pattern here. Everything waits until those keys are in your hand. All right, friends. That's going to be it here today. As always, thanks for tuning in to another 2-Minute Tuesday. If this helped you understand why credit changes during escrow can cause problems, well, subscribe for weekly real estate insights that bring long-term value to your buying and selling decisions. And as always, talk with your lenders and your realtor before making any financial decisions during escrow. Well, friends, it's time for me to turn off my camera to get back to work. If you happen to be in California, well, I'm a real estate agent right here in Orange County, California. Feel free to give me a shout if you have any questions about buying or selling. You want to see what's available here. And with that said, well, friends, that's all I got here for you. I'm going to be shutting off the cameras, and I will see you in the next video.